at the closing bell of the New York Stock Exchange, ending another trading week on Wall Street. The Dow went down by about 300 points.
And the S&P 500 and NASDAQ are, by comparison, relatively flat, both down less than a percentage point.
For more on this, Geetu Sharma joins us now. She's the founder and investment manager of AlphasFuture. Geetu, welcome. Great to have you with us. So what drove the markets today?
Well, it's always hard to comment on one day's move, but if you think about it, the data we've received today on PPI, inflation, and some of the data we've received over the last few days, we have a consumer who's very strong and is continuing to spend. We have strong labor market. Employment rate is still high at 3.7%. We have wage growth going on, and we have inflation, which is not declining as fast as the Fed would like. It's continuing to beat expectations. So what it really shows is that U.S. economy is still in a very strong state, and it really means that the interest rate environment is likely to stay higher for longer.
Yeah. As you say, there's several indications that the economy is healthy, but also that inflation continues. And along those lines, a producer price index report came out today, and it shows a rise in wholesale prices. How concerned are you about inflation and the continuing upward trend of costs going to impact the markets?
So, yeah, I think it seems that the inflation dynamics are getting more entrenched day by day. And it's really, while the drivers of inflation are changing, this time we had more inflation driven by fresh vegetables and due to supply chain disruptions locally than internationally. But at the end of the day, what we're also seeing is that it's the labor shortages and the wage increases that is going through, and it's getting passed into goods and services. So it looks like inflation is more sticky than we were expecting. And while we may be past peak inflation, it's not so clear that it will come down as fast as the market may be expecting or where the Fed would like to see.
And Geetu, I wonder whether this inflation, this sticky inflation, as you put it, has something to do with the fact that household net worth also fell for a third straight quarter. That's according to a report out from the Fed today. So can you walk us through what this means, not only for the everyday American who's seeing their household net worth, decline, but what this means for stock holdings?
Yeah, so yes, the consumer had, there was a lot of saving that got built up during the pandemic, and we had good real estate, housing prices, and the stock market, financial markets did very well. So all of that added to the individual net worth. Now, we are seeing some of that come down, but we are not seeing a significant increase in consumer debt levels. I believe that's still below the pre-pandemic levels. So there is a lot of potential still for the consumer to take on credit if that's what they want to do, to continue spending and to deal with the current high inflation environment. So I think it's not yet a sign of declining demand, while there is a shift in consumer spending from, pandemic-related products, work-from-home products, to a more reopening spending, including travel and leisure and experiences. There is still strong demand in the market right now, and that's kind of giving support to both the economy and the inflation numbers.
Yeah. Well, next week, obviously, the Fed is going to be deciding the latest interest rate hike. The indications, the expectations, 50 basis points. What implications do you think that will have? And do you think that, given all of these mixed indicators in recent weeks, do you think that 50 basis points is still on target?
I think so. The market is pricing in 50 bips, and I think the Fed also implied that in the recent meetings. I think it's more about the terminal. The questions are more around the terminal rate as well as how long the Fed stays there. There is an expectation in the market that the Fed will pivot soon or pause soon, and that market is pricing in rate cuts towards the end of 2023. I think some of this data which goes against that narrative, and from a market standpoint, it means if we do see high rates for longer, if the Fed stays in its tightening cycle for longer, it really could mean more volatility, more uncertainty for equities and for valuations in general.
All right, Geetu Sharma, thank you.
Thank you, Geetu.
Thank you.